Good morning, everybody. It is June 15th, and you're watching MarketStream.live, and we're checking out everything that's happening in Europe. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. And you know, I talk about Asia, Europe, and the United States, and how you build a portfolio, but I'm actually going to show you. The reason why I touch base on this is so that you understand that you're going to have, and you do have, exposure to your Asian markets, to the European markets, as well as the US markets. And specifically, what I put together, well, this is what I show my clients. Let's say that I have a client that has a $100,000 portfolio, and we're going to put 20% of that portfolio in the foreign markets. Why the foreign markets? Well, they'll react similarly to what's happening in the US, but they could be in different economic stages as far as the cycle's concerned. So with that being said, they could actually have more momentum to the upside if, for example, I want to put a bullish portfolio together that has exposure to foreign markets. So taking a look at this, what I did is that I basically show my client, first of all, this portfolio has a risk factor of 87. What does that mean? It's aggressive. It means that it's trying to take advantage of a very bullish and aggressive sentiment. And some clients say, well, that may balance out the fact that I might have maybe exposure to the bond markets or some other conservative asset class. So this could actually be my alpha. And so with that, they now understand that this is an aggressive portfolio. I also lay out to them a 6-month probability, and it gives you a 95% probability of being either down 22% or up 34%. Now that's basically if worst case scenario. In other words, as we call it in statistics, a 2 standard deviation move either to the downside or upside. And the downside is because I'm owning these underlyings. Now, what are the underlyings? Let's say, for example, and we've talked about this a ton here on the show, there has been a desire and a shift in getting exposure to Europe. So how do you do that? Well, you could go in and take a look at Germany and France and England and Italy and so on and so in Spain and try to pick stocks, but you can't get access to the market. So you use ETFs. This ETF FEZ, which in full disclosure my clients have exposure to, is the Euro Stoxx 50 that takes the top 50 stocks in Europe and it puts them in an ETF. FEZ is also optionable for those of you that are wondering. It has a dividend, annual dividend of 2.85%. So you know that you're already getting a kicker. You're already getting something, a stream of capital that's going to be coming in through dividends, and it's 2.85%. And you have an asset allocation of 35%. So if you have 20 grand, you're basically a little bit over $7,000 of this portfolio is going to be in FEZ. If you want to also get exposure not only to Europe, but also Asia, maybe South America, a little Africa, whatnot, Australia, EFA has a dividend yield of annual dividend yield of 2.66%, 34%. Let's say I want China. You heard, Joe's been talking about China's been basing. It looks like right now that, as we discussed this morning, the IMF came out and said that they're revising up the GDP of China. Well, that's positive for the mainland, and that would be positive for a Chinese ETF that tracks the 30 large cap stocks in China. FXI has also a dividend yield of 2.34%. And then let's say that you think in the UK, after they do a Brexit, but that the UK has been solid. You like also you're looking for yield. UK EWU is an ETF that tracks the UK stocks that are in the FTSE, and that has a 3.57% yield. You put 10%. So net, you basically have now your $20,000 that you've allocated of the $100,000 portfolio in this balance. What does it mean? It basically could give you a potential average return over the year of about 12.7%. It has an average dividend yield of 2.75%, which totally takes over and pays for the expense ratio of what it would cost to own these, because you'll have an expense ratio. And here's one piece that's not in this, and this is what will raise your risk factor to the downside and it will cap even a little bit more than your upside. And this is where I, as an advisor, offer a ripple that you won't have most advisors do. I'm going to overlay option strategies on these so that you're going to reduce your potential risk to the downside, and you may cap your upside. That's the trade-off. But here's the thing. If I can reduce my downside risk from anywhere between 3 and 8%, that means that I go from 22% to down to maybe 19, maybe even as low as 10% downside risk in my portfolio. Now this risk number goes from 87 down to maybe 65 or 70, and that will fit my clients' objectives and risk tolerances. So let's jump in and actually take a look at what's going on in the European markets. Now that you see how I look at this from a holistic perspective, how do I actually put a portfolio together? You can look at those 5 ETFs. As a matter of fact, I'm sitting down with all my kids. We're putting together, yes, I said my kids. I'm going to be putting together portfolios with them, and I'm going to have them start managing those based on that quantification that we just did there. These different exposures that we have, so that I'll walk through and say, here's your bucket of money. We're going to basically buy these underlyings. This is what your potential return is. This is your risk over the next 6 months. These are your dividends, or in other words, think of it like in the terms of bonds. These are what you're going to get, your coupons that you're going to get coming in. This is your expense ratio. Where's your most risk? Well, right now, it's in FEZ. This one from the heat map, and then the stress test. If they go, my oldest one will go, well, what happens if we have a crash again? What does this portfolio look like? Well, if we have the same 2008 crash, this portfolio would be down 45%. But because we're writing options on that, we can mitigate maybe a third to almost a half of that risk to the downside because we're selling options against the holdings that we have. This is where I'm going to teach them how to do this correctly, how they can diversify their portfolio and mitigate, more importantly, mitigate, not truly diversify, but mitigate capital risk while giving up some upside. But I have yet to see someone that has delivered unlimited upside profit potential. All right, let's take a look at what's going on in Europe, because there's quite a bit this morning. The German DAX is down 1.22%. That's good for 156 points to the downside. Reason you're seeing is that a hawkish Fed and the precipitous drop in oil. Oil is now below $45. Like I had said a couple days ago, and you can actually check out, I was on Bloomberg on Monday. I basically looked at oil in that $44 to $45 level. I am not buying in. With the glut of inventory, and the inventory numbers continue to show that there is either a glut of crude oil or there's a glut of the byproducts, like, for example, gasoline. Here, the RBOB contract, which tracks gasoline stocks, was the stocks were up 2.2 million barrels. So in other words, we didn't see a draw of gasoline, we saw a build. So the byproducts of crude oil, like gasoline, they're building, even though we had a small draw in the crude inventories. Names like BASF, Lufthansa, Daimler Chrysler, SAP, and so forth are all trading to the downside. So you're starting to see large cap names getting some profit taking. And again, watch this area right here. The challenge of this level right here, 12,244, that's the level on the DAX you're going to want to watch. That's where the short-term bulls are going to be tested. Taking a look at the French CAC. The CAC right now is trading down 57 points. That's good for 1% to the downside. You're seeing basically the majority of the names on the French CAC, on the French 40, down except for one. As a matter of fact, all 39 names are down except for one. Vivendi is the only one up about 0.3%. So you're seeing everything across the board. Financials, consumer names, energy names, all to the downside. And speaking of energy, financials, the UK. Right now, after the Fed came out, you saw a plethora of things. First of all, on the UK side, you saw that retail sales. They were actually down 1.2%. There was an expectation of being down about 0.8%. So you're seeing that it almost doubled the downside on retail sales. That means that the consumer in the UK, they're backing off a little bit, and that's a little bit concerning for the economy there in the UK, especially now that we have this Brexit discussions and whether it's going to be a hard or soft. It looks like it's going to be a soft Brexit. You also saw something interesting too. The Bank of England kept its rates and rate policy the same, but you had 3 times as many dissenters from keeping it at 0.25% and 435 billion pounds as far as infusion or purchasing power. This is interesting, folks. You're starting to see that these 8, we'll call them, they're like our Fed governors, are now dissenting and want to actually start looking to potentially raise rates. And unless you're seeing inflation, wage growth, and just overall economic growth, it's going to be very hard to say that you're not going to hurt the consumer by raising rates. We saw the impact of raising rates yesterday and putting together what seems to be a pretty aggressive unwind of the balance sheet going forward. The consumer is going to be under pressure. If you raise rates, that means credit card rates are going up. That means mortgage rates are going to be going up. That means short-term borrowing rates are going up. That is going to put pressure on the consumer, especially if the consumer is not making any more money. And we're seeing the sector in the UK that's getting hit the hardest right now this morning is the home builders. Home builders are taking it on the chin, and with the UK down 1.1%, and that's good for 84 points. That's the kind of action that we could potentially see occurring here in the United States because of the fact that we're seeing rising interest rate markets. We're seeing that the buyer of not only bonds, which is foreign governments and our government, is removing themselves from the market, as well as mortgage-backed securities are removing themselves from the market and are actually going to add more potential liquidity to that market. In other words, they're going to be selling it out. So we're going to have to find another buyer. The markets are trying to figure that out, and you see that they're sliding to the downside in Europe. So we'll watch this very closely, but you can clearly see, though, how do you quell these fears when you hear that they're down 1%, they're down 1.4% or 1.25%? Well, you look at the 20, the 50, and the 200-day moving average. If these markets are still above these areas, you know that the bulls are still in control, and until they start challenging the 20 and 50-day moving averages, this is an opportunity if you are a bull. You'll watch it closely, you'll manage your portfolios accordingly, and you'll watch MarketStream to learn how you can strategically optimize and get probabilities on your side. All right, folks, that's it for right now for On the Open in Europe. Join me at 9:30 Eastern, 8:30 Central Time. I'm going to be going over